Good afternoon, and welcome to the DoubleLine Smart Beta Webcast. Today's conference is being recorded. Please allow me to introduce President of DoubleLine, Mr. Ron Riddell. Mr. Riddell, you may now begin.
Well, thank you, and good afternoon, and welcome to the DoubleLine Funds webcast with Jeffrey Sherman and Jeff Mayberry. The title of today's webcast, Baseball, Elections, Taxes, America, Soccer. Not all betas are equal in 2022. Few webcast announcements. If you'd like to see the rest of the 2022 webcast schedule, you can go to www.doublelinefunds.com. Some upcoming webcasts on May 10th. We'll have our international webcast with some of the portfolio managers on our emerging markets and global bond portfolios. They'll be covering the DoubleLine Emerging Markets Fixed Income Fund, DoubleLine Low Duration Emerging Markets Fixed Income Fund, and the DoubleLine Global Bond Fund. Then up on May 24th, we have the Strategic Commodities webcast with portfolio managers Sam Lau and Jeff Mayberry. Also, you can visit us and sign up on our Twitter handle at DLine Funds. And we do have a new YouTube page you can go to titled DoubleLine Funds. If you'd like to receive today's slides, please click on the request in the Request Webcast Content tab. Some other YouTube channels, you can go to DoubleLine Capital and see the latest geopolitical roundtable, which featured our portfolio managers on the global bond portfolio, Bill Campbell and Valerie Ho, and was moderated by our very own Deputy CIO, Jeffrey Sherman. Ken Shinoda, portfolio manager, covering Channel 11, also on the YouTube channel. And then the widely acclaimed Sherman Show podcast. Please sign up for that. It's available on doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. Also on those very same outlets, you can also see the podcast or view it and listen to it on Monday Morning Minutes with Sam Lau and Jeff Mayberry, where they cover relevant weekly macro and market recaps. Today, Mr. Sherman and Mr. Mayberry will be covering 4 of the DoubleLine funds. Here you can see 2 of them, the DoubleLine Shiller Enhanced Cape and the DoubleLine Shiller Enhanced International Cape. Here you can see the different expense ratio and minimums. The other 2 funds that will be covered today is the DoubleLine Real Estate and Income Fund and the newly launched over the last year, the DoubleLine Multi-Asset Trend Fund. And both of those here are the different expense ratios and minimums. Just standardized performance. We'll first start with the DoubleLine Shiller Enhanced Cape, ticker DSEEX on the institutional share class. We launched that to 10/31 of 2013 and through 3/31 of this year, 15.28% annualized return versus the S&P 500 at 14.11%. That's an annualized outperformance of 1.17%. The DoubleLine Shiller Enhanced International Cape, the institutional ticker at DSEUX, DSU, that was launched at 12/23 of 2016 through March of this year, 9.79% annualized, versus the MSCI Europe Net Return USD Index at 8.27%, a 1.52% annualized outperformance. The DoubleLine Real Estate and Income Fund, ticker DBRIX, DBRIX, that was launched 12/17 of 2018 through the first quarter of this year, an annualized return of 13.45% versus the Dow Jones US Select REIT Total Return Index at 12.92%. An annualized outperformance of 53 basis points. And lastly, just over a year is the newly formed DoubleLine Multi-Asset Trend, DBMOX, and the return for a little over a year is at 7.18%. I'm sorry, that's annualized, and the 1-year return through 3/31 at 9.12%. So with that, I'm going to turn the webcast over to Mr. Jeffrey Sherman.
All right. Thank you, Ron. And thanks, everyone, for joining us today. I am broadcasting today from the state of Florida in Miami. And so I'm here down at the ETF Exchange talking about our newly launched ETFs, which one of these products does kind of sit within that space as well. So having a little bit of technical difficulties, but we'll get through it all, everybody. So with that, let me turn over to the structured slides. What you see here is the structure of the DoubleLine Shiller Enhanced Cape fund. This is the one that most of you are more familiar with. What we do with all of the assets that go into these strategies is that we build a fixed income portfolio. These are similar fixed income portfolios across all for the funds we're going to be talking about today. And those bond portfolios are put together to target a duration between 1 and 3 years. Today, not surprisingly, we sit at the very, very low end of that range, hovering near that 1-year duration point. And they're global multi-sector portfolios that try to find income-generating opportunities over the near term. And so those fixed income portfolios serve as collateral, which allow us to look to the right-hand side of the chart, which allows us to enter into index exposure on this, in this instance, the Shiller Barclays Cape U.S. Sector Total Return Index, and allows you to get $1 of exposure to the equity market for every dollar that's in the fund as well. So this is not a balanced strategy. It's what we call an overlay. I've noticed that some people have been calling this return stacking, where you're trying to get kind of more capital efficiency out of portfolios. It also had a name like Portable Alpha in the past, which kind of got a negative connotation during the financial crisis. But that said, this portfolio, the goal of the bond portfolio is to outperform cash, because we have to enter in these swaps, we have to pay a funding spread, which is cash related. That was a LIBOR-based rate. It will change to a SOFR-based rate towards the end of this month. But it allows us to try to outperform the index and not just settle for an index return that is the index return less the expense ratio of the fund. So we're trying to reduce some of these friction costs within the trading. So that's the way the structure works. So again, every dollar that comes into the portfolio, we build a fixed income portfolio behind that. This does not look like the total return strategy or core fixed income. This is a very low duration type of strategy that allows us to try to attempt to outperform cash. Obviously, it's been a challenging market for the bond market this year, but we'll show you some performance metrics on the fixed income portfolio. Although it does have a slightly negative return, it's held up relatively well relative to kind of traditional fixed income investing. And so we're going to cover 4 funds today. You can see this one. It's the second fund on this train. This is the DoubleLine Shiller Enhanced International Cape. Same idea. Money comes into the fund. We build this fixed income portfolio. It serves as collateral so we can go out and enter into an unfunded swap on the Shiller Barclays Cape Europe Sector Net Total Return Index. And so the exposure here is the European markets. Again, both the Shiller product in the U.S. as well as the European version are sector rotation strategies. And Mr. Mayberry is going to cover both of those for us today. I'm going to talk about the 2 newer funds today. Talk about the real estate and income portfolio. Again, same structure. Once again, these are not redundant slides. They're just slightly different in terms of the overall exposure that you get here. Bond portfolio, we overlay through a swap. We get $1 exposure to the Digital Bridge Fundamental U.S. Real Estate Index. And so I'm going to talk more details about how that index is constructed. And then as Ron mentioned, 1 year ago and 2 weeks ago, 1 year and 2 weeks ago, or no, sorry, it was at the end of February of last year, we launched the multi-asset trend portfolio. And so this is a strategy which may not be as familiar with to investors out there, but it's one that tries to take advantage of trend following and momentum across 58 different markets within the global financial system, and try to apply momentum and use that as a basis for either entering into long or short positions on various parts of the market. And so those of you that follow work on valuation know how important momentum can be. You know how we use that within our Shiller Enhanced Cape and our Shiller Enhanced International Cape products. And so we think momentum is definitely something that can help investors, especially in a very challenging market. And so that portfolio or that strategy has lived up to its expectations. So let me start with this strategy to start with. I'm going to take them in the reverse order. I'm going to start the multi-asset trend fund because I think when I'm speaking to investors today, people are looking for things that are not correlated to these traditional markets. And the multi-asset trend fund happens to be one which we think can generate potential uncorrelated return streams relative to traditional asset classes. And so, excuse me. So if you look on the screen, you can see here that the strategy combines two unique sources of return. As I mentioned, we are trying to build this fixed income portfolio that will serve as collateral to enter into a swap. But we've partnered with BNP Paribas, that's BNPP on the screen, and we worked with them to create an index that applies these principles of momentum, applies some of their thought leadership that they have provided within this space. But we did it, and we kind of narrowed the universe down from a larger universe set that BNP was looking at to something that's much more liquid and tradable and is available in the 40 Act wrapper. And so, again, this is an overlay strategy. What we do, we build a fixed income portfolio, and from there, we get exposure to this BNP Paribas multi-asset trend index. And so this is the one place as an investor you can get access to that index. And so why would someone really care about investing in momentum? Well, if you do some work in the financial literature, you'll see that if you go to the Fama French website or you go to Ken French's website, you can pull down the momentum factor. And this is a long-short portfolio where they rank based on its 12-month momentum. They go long the top decile of securities, which have the most momentum, and they short the basket of securities, the bottom decile, which have the least momentum. So that's how factor portfolios are constructed. And so you can see here that there tends to be, kind of a persistent and pervasive trend in the momentum process. And you can see here that it's been a pretty attractive market. Again, this is market neutral, the data set that we're looking at here. And so it does not include the market beta whatsoever. This is just a long, short type of market neutral portfolio. And if you apply this principle out to other asset classes, which again, this is a multi-asset trend strategy. And so by thinking about multi-asset trend, you want to know, does this work outside of just equities? And we show here is using the AQR data set. This is something that Peter Frazzini put together over at AQR. He's a researcher as well, and he's done a lot of good work on illustrating this concept that momentum tends to be pretty pervasive across multiple asset classes. And so you can see here that it's not just stocks, but it's international stocks, it's fixed income, it's currencies, and it's also commodities as well. So moving on to the next slide here. So what we did, we talked about, again, the fund itself. This is the structure. We had talked about that. Bond portfolio is built short to intermediate duration, trying to outperform cash on a gross basis. And then we simultaneously enter into a swap on this BNP Paribas index, this multi-asset trend index, which gives us exposure to this multi-asset trend strategy. And so let's talk about this index and what it looks like. This index is something that focused, I said, it was on 58 different underlying markets. 19 of them sit in the equity space, from small cap US, large cap US, Canadian stocks, German stocks, French stocks, Euro stocks, UK. You get Asian stocks in here too. You get the Hang Seng, HSI, you get Nikkei, you get Topix. So you get a global portfolio of equities. And again, each of those individual markets can either be long or short, and I'll talk about how that's determined in a little bit. Also trades 15 different parts of the rate curve. These rates are across different markets, whether that's Aussie, whether that's JGBs, BTPs, which are Italian, Canadian rates. You have the Deutsche rates or German rates. You also have OATs, French OATs. You have UK when you talk about the gilt market as well, and then also U.S. Treasuries. And so it's going to take different positions across different parts of those curves as well. Also, it trades credit. So this is CDX type of exposure when you think about it, whether that's investment grade or high yield in the U.S. Same thing within the Eurozone as well. 7 different currency pairs through the Forex markets, and then 13 individual commodities as well. So a very robust system applying all these principles on momentum. We've done a lot of academic research in this area as well, and we think that this is a good strategy for looking at ways to generate uncorrelated returns relative to traditional asset classes. So moving on to the next slide here. These are the various markets. I described them at a high level. You can see in here with various parameters. You may have to zoom in on your screens a little bit, but ultimately this uses the futures contracts in these various markets. And so the index itself will reference the futures contracts within these individual 58 markets, and it can either go long that market or it can go short that market. And you can see on here too what the minimum and maximum exposures, both in terms of a long and a short exposure, can be within these markets. So each individual market, these 58 markets, is assessed. There's a formula for coming up with how to assess the strength of the momentum in that. We really like this underlying process. We think it's relatively unique, where it's not just saying, let's look at the last 12 months return, but it compares what has happened over the last 12 months, where we are at today's price levels relative to every single data point over the last year. And so for those of you kind of in the nerdy math camp like me and Mr. Mayberry, you can think of it as like a cumulative distribution function where you say, okay, how much momentum do I have today relative to that overall market? And then proportionally to the volatility, it creates a return signal. So something to really think about in the asset allocation model when you're building these things and looking for different asset types that can provide diversification benefits. So as you see on the screen now, I show this process is dynamic. It looks at each individual market, so it's not lumping them together to come up with these positions. You can go short, you can go long. There's no cap on how much net or gross exposure you can have at the aggregate portfolio level, and so it allows you to be extremely agile. Again, this is systematic, it's rules-based, it actually does the assessment every single day. So each day the portfolio is reassessed, re-optimized, or the index itself has done so, and that is constantly going through the process and adjusting to really target that volatility level. And so again, I think what BNP Paribas put together was very unique in this manner of assessing momentum. And again, it's just solely a quantitative process. It's a little bit hairy in the math when you start to look through it, but ultimately it's one that we dug through. We understand the process, and we feel very comfortable with bringing this out to our clientele. And then lastly, again, just within the risk controls within their just position limits, just looking at also aggregate portfolio and taking out some of the kind of things of covariability within the portfolio, making sure you're not loading up on things that look uncorrelated, but ultimately are. So something like WTI crude oil versus Brent crude oil, you got to know that those are going to be very highly correlated to each other. So if the math just isn't working because of some timing difference or something else, you still make some adjustments for that. So again, reactive to market conditions. We saw this even during the heightened volatility we saw around the Ukraine crisis, that the portfolio was really able to react or the index was able to react and adjust to be able to take advantage of what was going on, but more importantly, to also keep that risk profile at the target level. If you look on the screen now, since we've been live with the index, which it went live about a month before we launched the process. There is a longer history on the BNP family of indices. It's just the one that we had them help create for us. Again, what we thought is more liquid and just has the ability to navigate a little bit better, went live in January of 21. And so you can see here that dark blue line is the drawdown of the trend following index. You can see at times it's going to underperform, for relative to its market high. But notice what you see during that crisis, it was able to step in when the markets were going down and take some of those short positions and be able to essentially gain the returns in the market when the rest of the markets were falling apart. It was able to take advantage of that. So again, we think that it's a very timely type of strategy and one that investors should really think about. And so we're big fans of momentum in general. We use it for our technical analysis when building our bond portfolios. And so we think that it definitely is something that should be on investors' radar. If you look at the historical composition of the index, again, it hasn't been around for very long. There are longer time series and backfills and things that we can't show you in this webcast. But ultimately, you can see here that, as I mentioned, around the Ukraine invasion, you can see that the portfolio went very net short. So it is highly reactive. All those things I was professing that it can do, it actually did do in times of turmoil. So you can see on here, we show the average exposure at the table up top, what the average exposure has been to the equity market, rates market, currencies, commodities, credit, when it's been long, what's the average long exposure, when it's been short, the average short exposure. So you can see here that it has on average had about a 333 or 313% long position. And also when it's been short, it's had about 148 net position. So you're not getting levered to the traditional sense. We're not borrowing money out there. This is simply just futures contracts. And so with margin requirements and the like, it allows you to have that tilted portfolio. But again, the idea here is not to create some leveraged strategy that is trying to just only generate return. It's trying to deliver this kind of diversified basket in what we believe is an uncorrelated return stream. So what does it look like relative to traditional markets? This is it's short time series that we've had since we've been live. This is the fund performance, DBMOX, as we call it. It's MO for momentum. Get about an 866 vol. So it's had about half the volatility of the stock market, and it's had about twice the volatility of the Barclays Ag. Look how horrific that return is on the Barclays Ag. I'm sorry, it's the Bloomberg Ag. I know maybe I'll correct me on that. The Bloomberg aggregate now, it's even worse today. Actually, it's rallying a little bit today, but as of last night, it was down by 8.3%. But as I mentioned at the bottom, look at the correlation of the strategy relative to the other parts of the markets. And so we do think this belongs in a diversified portfolio. We are big fans of momentum and trend following in general. And so we think that advisors and clients should be out there taking a look at this type of strategy. So I know I went that very quickly. Just want to give you a teaser out there. Reach out to fundinfo@doubleline.com if you want to learn more about this strategy, or reach out to your global relationship manager who covers your accounts to get more information. We'd love to talk to you about that. We think, especially as things get much more challenging with a less accommodative Fed, that ultimately these type of strategies will have their day in the sun and can help get you away from just that traditional 60-40 type of portfolio. On the real estate and income fund, again, same structure we talked about. Why would you invest in REITs? These are non-mortgage REITs, so these are brick and mortar. And the nice thing about REITs is that as you expand your time horizon, what you find is that the return streams tend to be much more correlated to property markets than equity markets. So a lot of people think, and there's this misconception about REITs, that they're just essentially a rates trade, or that they have so much equity beta in them within the marketplace, and that can be very true in the short term. But as one expands their horizon, you can see here that dark blue line is the correlation to the NC REIF ODCE index, which effectively measures commercial real estate prices, and that allows you to be able to look at those. And so I don't know if I showed that slide. As I said, I'm having technical difficulties, but that was the slide I was trying to show. The next slide you can see here is that if you look on a valuation basis relative to the S&P 500, that REITs have really, really significantly underperformed really over the last 5 or 6 years. They did do well in 21, and they did outperform year to date so far in 22 relative to the S&P 500. So this is a broad index of REITs. This index does also include mortgage REITs, which are not in our process over here. So this is an index that we have licensed and we use from DigitalBridge. We think that DigitalBridge did really great work, in thinking about how they've been running private and public funds for many decades, and essentially trying to bring their quality over value focused approach. And so the thing about when you look at REIT indices, you can't use the traditional factors like book value or book to value, the traditional value factor, or just look at yield. Again, that's where people have this misconception that it's just a rates trade. Higher yield in REITs typically connotes a lower credit quality, just like in credit in the fixed income world. So applying the traditional factors just doesn't really work in the REIT space. And so DigitalBridge came up with a way of systematizing their selection process. And so what they did is they took the entire universe of REITs and you exclude the mortgage REITs. Why exclude the mortgage REITs? They are more of a levered play on rates. They're more focused on kind of the shape of the yield curve as well. So they don't really give you that kind of brick and mortar exposure that we're seeking as product. So the filtration system is to get rid of those mortgage REITs. You also need to have a significant enough market cap. Again, economies of scale work in your favor in real estate transactions. You also want liquidity, right? If we're going to trade this stuff, we need to be liquid. And then there's definitions of quality, profitability, leverage, and valuation, which are the criteria for selecting which REITs one wants to own. From there, once you select that based on these filtration systems, then ultimately, based on market capitalization, you weight the portfolio of those that pass all of these threshold tests. And so the key is that you don't want, there are a couple of very large REITs out there. So you don't want to just load up and have really a lot of idiosyncratic risk. So the top 4 constituents can't be more than 10% cumulative, and everything else is subject to a 5% cap in there. And so you just got to have at least 25 REITs in there to achieve that diversification. So what does this look like? If you take a look at the characteristics as of quarter end, you can see here that the REIT index has a yield that's very similar to that of the overall market. It's a little more concentrated. It has about half the constituency. It has a larger market cap. Again, that's one of the screens for thinking about the economies of scale within there. So you can see that both in the weighted average market cap and the median. And it's a little more concentrated than the overall index. But again, from a risk tolerance standpoint, we think it behaves very similarly to the broad market, and there's significant potential for alpha generation. And you can see this here if you look at the next slide. You can see that residential REITs, roughly a similar weight in the digital bridge index currently as would be in the broad market. But notice that there are no infrastructure REITs in the broad market index, but there is a significant piece here. So if I look at resi, I look at infrastructure, things that we like in the commercial real estate market, by the way, from a fundamental standpoint, things that our our CMBS teams are overweight today, they are residential, multifamily, they're infrastructure. It is the storage facilities, data center, industrial related assets. And so these types of things are exactly what are being screened in here, even though we're not having any input into this. Our CRE teams, or our commercial real estate teams, agree with some of these kind of weighting schemes and how they're thinking about this. Now, remember, our team is looking at it on the CRE side from a debt perspective. This is more of an equity type of investment. But these are things that are focused on what I'll call the newer economy, things that we need significant in this country. Residential, right? We need more multifamily housing. We all know the challenges with the supply and housing market. Infrastructure, been waiting on a deal for 6 years. Don't think we're still getting one this year. But again, ultimately, infrastructure is something we need. Storage, this is America. We love to store stuff. Data centers, retail is a big underweight here. You can see the healthcare is slightly underweight too. Office, again, the death of the office, as you saw Ron Riddell, he's sitting in his office today. It's greatly exaggerated, and actually there's some good opportunities in these spaces. So in general, this focuses more on what I'll call the newer economy than necessarily thinking about the old economy. So if you look at the portfolio, the bond portfolio here, you can see the allocations. It's a portfolio that does have a very low duration, a duration around 1 year, very high credit quality, hardly any below investment grade exposure within the portfolio. So again, trying to grind that out through income generation. And if you look at the performance of the strategy, the DoubleLine Real Estate and Income Fund, again, you can see the standard deviation right in line with that of the index, but been able to outperform the index by about 102 basis points per annum since the launch, roughly about 3 years, and I think it's about 3.25 years at this point in time. So again, we think that these type of strategies, although not as familiar with all of our investors, do warrant some attention out there. For those of you that invest in the REIT space, we think that this is a very good product to complement some of those exposures out there. And also when thinking about asset allocation, for people who are looking for those diversification, to look at the multi-asset trend strategy as well. So with that, let me turn it over to Mr. Mayberry, who will cover the two CAPE products. Mr. Mayberry, the floor is yours.
Thanks, Jeff. And being a road warrior that you are, it's pretty noble of you to do this from a hotel Wi-Fi. Anyone who has been traveling knows that it's a tricky scenario there usually on using the hotel Wi-Fi. So I'm sure it's much appreciated from our viewers there. Let's shift our focus over to the DoubleLine Shiller Enhanced CAPE. And here we're investing in the U.S. side of things, S&P 500. And so one of the things we want to look at is where's the CAPE ratio of the U.S. equity market today? And you can see we're off the relative highs that we were earlier late last year, and we almost got to about 40. We're down to about 36 here on the CAPE ratio. And so when you look at it, though, people always talk about the CAPE ratio as not really you don't really want it to be a timing signal where you're buying or you're selling CAPE, getting out of the market when CAPE is at a high level, and buying when it's at a low level, because if you look on this chart also, you can see it averages around 24. And so there's not really that many times when it is below that 24 average. So you would have missed a long uptrend there in the market if you bought below 24. Hasn't been below that level. It kind of got below that level real quickly in 2020, but it's been above that level for a significant period of time. And so, really, you want to look at it, and when you do look at the research that Professor Shiller did on when he introduced the CAPE ratio, really what you're looking at is saying higher CAPE ratio, lower future expected returns, not negative future expected returns, just lower. So you don't want to use this as a timing signal, but one of the things we'd like to do is look at it as terms of a sector selection, which is the basis for the DoubleLine Shiller Enhanced CAPE Fund. And so one of the things that we had to change in this is that if you look on the left-hand side here, you can see the CAPE ratio of two different sectors, and we chose the two sectors specifically for technology being the dark gray line and utilities being the blue line. And really, when you look at those sectors, if you were using a two-sector selection rule using the CAPE ratio, you would say utilities always look cheap relative to technology, and so you would always be in utilities and never be in technology. Now, it doesn't really make sense from a sector rotation type strategy. So what Barclays did when they put this index together, they calculate something that they called the relative CAPE ratio, and that takes the current sector CAPE ratio, divides it by the 20-year average, so you have 30 years of data into the relative CAPE ratio, and so you compare the current CAPE ratio to its history of itself, and you can see that if you look at it in this, we think of it more as like a normalization factor. You can look at the relative CAPE ratio and say, okay, there's times, and certainly since the financial crisis and before, where technology, according to this metric, is cheap to utilities. And so from that sector rotation type strategy, it makes sense to have a much more normalized rule. And so using that basis, you can calculate the relative CAPE ratio and the relative CAPE ratio for all 11 sectors of the S&P 500. So here's the sector selection rules from the Shiller Barclays CAPE US Sector Index. So if you remember back to the structure slides that Mr. Sherman showed, it has the two pieces on the bottom, the fixed income side, and then the index side. So here we're looking at the index for the US large cap space. And from that, you have so you take the 11 sectors of large cap space, calculate the relative CAPE ratio, choose the 5 cheapest sectors or most undervalued sectors according to that metric. Then you always want to be kind of wary, and as we talked about or as Jeff talked about in the multi-asset trend fund, you always want to be wary of that momentum, be wary of that sector that is cheap and cheap for a reason. I always like to use energy in 2015 as a good example of that, or even more recently, maybe communication services over the past few months. It's cheap for a reason. Maybe you want to try not to catch that falling knife, avoid that value trap. So what we do is out of those 5 sectors, calculate the 12-month total return for each of those sectors, remove the sector with the lowest, so with the least positive or most negative return. So you're left with 4 sectors, equally weight those 4 sectors, do this process once a month at the end of the month, and that's how you get to your sector rotation strategy across using those 4 sectors. And here, if we look at the relative CAPE ratio for the markets today, you can see energy off the charts. We should probably reduce that or change the vertical axis there, because you lose a lot of information there in the other relative CAPE ratios that are all jumbled together. But hopefully we do have the legends here in order of richest to cheapest, so energy being the richest, communication services being the cheapest. So if we were to run this analysis at the end of March, your 5 cheapest sectors would be healthcare, staples, real estate, financials, and communication services. Remove the one with the worst 12-month momentum, in which the case this is communication services, and you would be in the 4 sectors: financials, real estate, staples, and healthcare. And so when we do that, and we do that over time, every month, you can see here, this is the sector rotation over time. And since we launched this fund on October 31st of 2013, you can see that we've been in every single sector of the market except for utilities during this live period. We were in communication services pretty consistently since that sector kind of popped into the market, and we were out, I believe, back in October of last year. We've been moving more towards the value-oriented side. So we are if you are in real estate, healthcare, financials, and consumer staples, those more value-oriented approach is something that when we look at the market, when we look at the sectors that we're in, we're very happy. We have no say in the sectors. It is a systematic rules-based strategy. Barclays does it every single month. They give us the sectors, and we invest in the index. but we are very happy with the sectors that came in. And why are we happy with that? We look at the U.S. equity market, S&P 500 value divided by S&P 500 growth. You can see that, at financial crisis, it was at a high of 1.18, that ratio. And we're at least we're off the lows now at 0.51, just barely off the lows of 0.44 there. But really, you look at this and you say that the growth has outperformed value by so much that it's really hard. It's really hard to imagine a future going forward where, at least over the kind of medium term, where the growth is going to outperform value. So we're pretty happy with the fact that this sector rotation strategy that is using the systematic approach is choosing much more value-oriented sectors to be invested for at least over the next month or so. But we've been in all year. And it's worked so far. Year to date, you look at technology, discretionary, and consumer services are your three worst performing sectors of the S&P 500. Certainly, energy up 40-ish% or so through last night is your best performing sector. But your other more value sectors, your consumer staples, your healthcare, are your kind of third and fourth ranked sectors of the market, and then financials and real estate are negative, but still outperforming the S&P overall. So this sector rotation strategy has worked thus far on the in the U.S. market thus far this year, and we expect it to continue. There are going to be some speed bumps along the way. We don't expect it to work out every single month, but at least we know right now that it is working. If we do go back to when we did launch the fund here, what we call DSEX, DSEEX is the ticker. You can see that this is just the index again. It does not include the fixed income side. You can see that the index has returned 15.01% annualized for that 8.5 years or so since we launched the fund. S&P 500 368. So we have an outperformance of 130-ish basis points there on just on the index return, with a very similar standard deviation, and that leads to a higher Sharpe ratio. So let's shift gears for a second into the fixed income side of things, where we do look at the duration. As certainly it's been a little bit of a bumpy ride here so far this year. We want to keep on the lower duration side of things. As Mr. Sherman said, we run from a 1 to a 3 year type duration. 1.17 is on the lower end of that range. We've been pretty consistently on the lower end of that range so far, for the past few years, as we thought it didn't make sense to extend duration. You're not really getting paid as much to extend duration. But you can see here, we have a very diversified portfolio. Most of it is in U.S. Treasuries, 20% in U.S. government. We have some floating rate CLOs, 17%, another 8.5% in senior secured bank loans. So about 25% of the portfolio there is in the floating rate aspect. Certainly in times of Fed raising rates, certainly have started the cycle. Whether they continue and start doing 50 basis points hikes remains to be seen. But in that case, we do want to have some good floating rate exposure, about 25% in pure floating rate exposure. Makes sense. And then you can see that it is diversified. We have agency RMBS, agency CMBS at the bottom there. Your no credit risk. But really, when we look at it, we're not taking on a lot of risk in the portfolio. So if you look at the ratings distribution, if you kind of sum up your government, your agency, your investment grade, and your cash, we're about 77-ish% there in investment grade and above credit rating, where you have a very 22% or so in below investment grade or unrated securities. So we're not taking on a lot of credit risk there. As Jeff said, we're only trying to get a couple hundred basis points over LIBOR or SOFR. So we don't need to feel like we need to take a lot of credit risk to get that return. Just trying to add incremental performance to the portfolio. And you can see over time, because we've had a long time with this strategy and this fund, you can see it makes a lot. The bars are a lot thinner, and you can see the larger moves we've made. We have a pretty consistent allocation to emerging markets. We're probably, looks like we're about at our minimum, or the lowest we've been in emerging markets. Not that the minimum would be 0, but the least position we've had in emerging markets. High yield, you can see we had high yield up in the beginning of the portfolio. That went away in 2015, and we've not been back in high yield. And then you can see the bank loans, as we like that and bank loans and CLOs, as we like that floating rate exposure, has increased over the past 12 months or so. And really, we are actively managing this fixed income asset allocation, trying to provide investors with kind of the best of both worlds, best of the fixed income side, and best of the equity side of things. And if we look at the performance, you can see that dip there in 2020, given the COVID shock. The rebound was relatively quick. By the end of the year, we kind of got back up to the previous level. And then you can see the little drawdown there that we've had so far this year, given the rise in rates, the pretty substantial rise in rates that we've seen so far this year. As Jeff and I were talking while the video was playing, he was on TV, and the 10-year was at 173 basis points, and that was like beginning of March. And so here we are, middle of April, month and a half later, 5-6 weeks later, and the 10-year's up 100 basis points. And certainly on the short end, on the 2-year at 240, it's at 240 today, right now. It was at 238 when we first started the webcast. That really you're at a place where that there's nowhere to hide in the fixed income market. So even though we've had that little bit of a drawdown there, we still think we're adding incremental performance over LIBOR. If you do look at the performance over those 8.5 years, we've outperformed LIBOR by 176 basis points per year. So that's additive to the portfolio. We do have a little slightly standard higher volatility. A lot of that's just due to that drawdown we did see in 2020. So put it all together. Put together the Shiller Barclays Cape Index. Put together the fixed income side, and over the last 8.5 years, this DoubleLine Shiller Enhanced Cape has outperformed the S&P 500 by 140 basis points per year for those 8.5 years. So again, slightly higher standard deviation, but a higher Sharpe ratio. So this product is working as it is supposed to. We're adding incremental value from the fixed income side. The Shiller Index is adding incremental value over the S&P 500. Put them together, and we get that incremental value for the end investor. If we shift gears slightly, we'll still look at the stock market, same type of rule set here. So we'll go over that part fairly quickly. We'll look at the DoubleLine Shiller Enhanced International Cape, and that is invested in the European equity market. And so here we have the same chart in red as before, the U.S. Shiller Cape ratio, 35.7. If we shift over to Europe, European equities look cheap relative to U.S. equities with a Shiller Cape ratio of 22. Again, remember earlier, it's not a signal for being in or out of the market. But if you have to choose, I would choose to invest in the market that has a lower Cape ratio, has higher future expected returns over a long cycle. And if you look at it in another way, here's the similar to the growth versus value chart that I showed earlier. Here's the MSCI Europe index versus the S&P 500 index. And I was going to say we're on the lows, but it looks like we bounced off the lows a little bit. Low of 0.81. We're very recently we're at 0.85 today. So if you're looking at the performance, you're like, oh, I missed the boat on the Europe. I think this still this is a very large chart or a very large axis. So there's a long way to go there for European equities to catch up to the S&P 500 performance. And so we think it makes sense to rotate, diversify into more European equities, and maybe reduce your U.S. equity exposure slightly from there. Here we look at the sector selection rules. It's the exact same rules. A couple nuances is that the Europe only has 10 sectors. It doesn't have the real estate sector. But you're still choosing the 5 cheapest, kicking out the one with the worst 12-month momentum, equally weighting those 4 sectors. And because the euro hasn't been around for 30 years, we're right now at 20 years of index value. So you're taking the current Cape ratio and comparing it to the 20-year history, 20-plus year history. I think at the bottom it says 244 months. But that keeps expanding every single month. So next month it'll be 245 and so on until we get to 360 months of data. And then it'll just continue rolling there. So that's a little bit of a nuance there from Europe, but generally the same idea in terms of the sector rotation. The interesting thing about Europe is if you remember from the US chart, energy was off the charts high. Here, energy is the third richest. Tech was one of the, it was kind of in the middle of the pack there in the U.S. Here, tech is it's not off the charts anymore, but it used to be off the charts. But you still have a lot of the kind of value. You still have staples and healthcare and financials plus real estate in there. But you also have communication services and just consumer discretionary in Europe. So it gives you a little bit more of a differentiator in terms of the sectors. You're not all in Europe. I mean, you're not all in value right now. You are in a little bit more of a differing market there in Europe. So we think that it's hard to do enough diligence there in overseas as you can do in the U.S., being kind of U.S. based. But we think that the systematic approach it works for this type of strategy. And here we can look at the same type of chart we showed for U.S. Cape. You can see back from December 2018 when we launched, we've been in every sector thus far in the market except for technology. And given that technology is still the richest sector there, it's going to be a little bit of while there before the technology kind of rolls into the index. If you look at the performance then of the index, the Shiller Barclays Cape Europe Sector Index, you can see that over this is since we launched our fund there in December 2016. Up through last night, and you can see that the index has outperformed the MSCI Europe by 243 basis points per year. Actually, this one actually has a lower standard deviation, and it gives you a much higher Sharpe ratio there from the US or from the Europe side than in the US. If you look to the fixed income side, it's not as diversified as the Shiller Enhanced Cape Fund. That's just because there's a little bit smaller portfolio, so we're not into something like emerging markets, or we're not in. We have emerging markets, but we're not into a lot of the other or some of the other sectors in the same kind of size and breakdown as in the U.S. Cape sector. The U.S. Cape Index, but here we're still diversified. We're still running 76% investment grade and cash. But running the diversification, you still have your CLOs, you still have your bank loans. So same market ideas, same team, same portfolio managers running that fixed income side of things. Here again, you can see it doesn't look as pretty as the other soil chart for DSEEKs, but for DSU, because we don't have that long history. But you can still see you have the same general move, same allocation across the fixed income markets. Similar performance here. You don't have the great performance pre-COVID crisis, but still outperforming LIBOR by 109 basis points per year. So this one is also giving you that same. It has that same look as the D6 fixed income portfolio. Let's put it all together again. So we have the one piece, the Shiller Barclays Cape Index. We have the MSCI Europe. This legend is mislabeled. It says Shiller Barclays Cape Index, but it's actually the DoubleLine Shiller Enhanced International Cape Fund. So this is at the end of the day, we're returning to investors 10.34% annualized since inception. MSCI Europe is 7.96%. So over the past 5.5 years, this product has outperformed the index by 2.38%. So again, we're taking that fixed income side, adding incremental value to the value provided by the index, and delivering that end to investors. And with that, that's all I have on U.S. Cape and European International Cape. I think Jeff is going to come over and answer some questions. But Jeff, before we do that, we put in the title Building Better Betas: Baseball, Elections, Taxes, America, and Soccer. And I'll let you cover baseball. We had a French election the other day, so at least, or I guess a preliminary election. So at least the kind of mass that event risk is out of Europe. So maybe it's a good time to buy European stocks. Taxes are due in less than a week now. Again, taxes in America kind of go hand in hand. And right now on the S for soccer, I'll cover that one. We do have Champions League going on right now. For anyone that's recorded it, I won't spoil anything. And actually, I don't know what's happened because I turned it off to do the webcast. So with that, we'll go back to Jeff to answer any listener questions that we had.
All right, thanks, Jeff. And baseball's back, baby. Manfred is trying to destroy it by bringing the designated hitter to the National League. All of us purists hate this. We think it's stupid. I'll only hope they come to their senses and realize how stupid the additional runner in extra innings was, putting the runner on second base, and they got rid of that rule this year. So hopefully they stop monkeying with this and go back to just the traditional things. I was chatting with one of our colleagues the other day. We're just talking about how important the double switch is and everything. Look, if I want to DH, I'll watch AL baseball. So we all know that the best baseball is in the National League. So with that, I'm sure I offended a few people. So let's go on to the real questions, Jeff. So someone says, it's directed at me. So 2's 10s did invert slightly for a short time, But should we be focused on the 3-month, 10-year more? The answer is no. 2's10 is the OG signal. It's got the street cred. It's signaled every recession that we've ever had. And one thing about it is that we did steepen. So it was inverted. Then all of a sudden, the curve steepened as soon as Brainerd opened her mouth last Tuesday about the balance sheet. Then we got the Fed minutes the next day. And you've seen this kind of 2's10 steepening. We're about like 27, 28 basis points today. Bad news is that usually after you invert, it's once the curve starts to steepen, that's when you should really get on the recession watch. Good news is that it typically takes about 9, 12, 15 months or so for that to happen. So I think we'll all stay on alert. This isn't a sign of relief yet. But ultimately, I do think that 2's10s are what you watch. 2's roughly, they haven't really changed kind of the terminal rate where the Fed is going, but they've ultimately just changed the path of hikes. So my sense is that it's a 50 basis point hike in May. It's a 50 basis point hike in June. And potentially the market's getting around to almost price in 50 for at least a 50% probability of a 50 hike as well in July. So just think about that. We would go from 0 interest rates in that scenario to 175 on Fed funds. So I think that there is a little more pain to come in the fixed income market. Good news is I think that, we're like 80% of the way through the move on the repricing. So, momentum has been very poor over the last 5 or 6 days. We needed a relief rally. We got one in rates a little bit today. The curve kind of just stayed in the same kind of steepness where it is. But definitely the bond market is reacting to the inflation prints. I think it rallied on the inflation print. People took a sigh of relief and said, well, looks like maybe indeed core inflation is towards peaking. We think it either peaks in this print or the next print and starts to decelerate. Bad news is it's likely to stay elevated for at least the next year or so. So very good question there. Someone says, why with the international fund? Why Europe? Why not Japan, Canada, et cetera? And so we wanted to launch a European fund. There happens to be a rule within the SEC that tells you that if you use the name of a country in a fund, you have to have 80% of your assets within there. And because we use a swap to gain our exposure, when we enter those swaps, they have 0 market value. So international, we had to rename the fund to that. Our intention was to call it the European Cape to just solely focus on the European market. We think it's a large economy, and we think it's an area where these principles can apply quite well. So it's really more of how the naming convention came about. And I fought the SEC, and as most people who fight the SEC, I lost. So the way we got it launched was to call it international. So it's a good question, but the intention was for it to always focus on Europe. Someone's asking about how is the BNP multi-asset trend performance compared to risk parity strategies? They shouldn't be related. So risk parity generally targets some kind of vol target. So I get where that question's coming from. But risk parity typically uses stocks and bonds to get there. So they lever the bonds up, kind of de-lever the stocks down by putting less into there. And that's what targets that specific volatility. Risk parity strategies have had a horrible time this year. So what you'll see is that trend following is not related to risk parity. I can see where potentially one would think about that. Risk parity also depends significantly on correlation, where momentum does not as well. So some key nuances there. If you want to talk more about that, fundinfo@doubleline.com. Someone saying adding more commodities to the mix. No, the 58 markets are the 58 markets. So thanks for that question. Expected tax efficiency or tax impact. All of these are trading off the futures market. So they get what the tax treatment that futures would get you. It all gets piled back into the swap. So ultimately, our goal is to own these swaps for longer than 1 calendar year. And by doing so, that should turn all of the returns into long-term capital gains. So even though there is that turnover, effectively what we're doing is you're looking at the index exposure. You're not looking at the individual pieces. So there is there's trading costs, obviously, that's baked into the cost of the overall index. And it comes out of there for all of that portfolio allocation. Also, when the portfolio is being optimized, I keep saying portfolio, but I mean the index. When it is optimized, when you do optimization, you can create a penalty function for transaction costs. So that leaks into there. So it's not just whipping around. And And again, because of the way the signal is generated, it tends to be a more fluid and a signal within the marketplace. So again, happy to get someone on the phone and talk you through this, put you on a Teams meeting, and really go through kind of how that works. Next is who's Digital Bridge? Was this Colony Capital? That is correct. You are very astute, and you referenced the person running there. Yes, that's correct. They partnered with someone else and became Digital Bridge, and so they renamed the entire firm Digital Bridge, and again the index as well. So yes, Digital Bridge is the new name for Colony Capital. Someone's asking, would it be useful to look at the CAPE risk premium over the 10-year yield to just the CAPE ratio itself? And I know Professor Shiller put out some work on this. He sent it to us before he published it as well, talking about elevated CAPE levels. It's not necessarily that the CAPE elevation is as bad when you compare it to where the inflation-adjusted real yields were in the bond market. And by the way, real yields are still quite horrific in the bond market. So that is part of the rationalization that people use for elevated CAPE risk. But if we were actually doing that within the strategy, and you just look at the risk premium over the 10-year yield relative to every sector, you're subtracting the same number from every sector, and therefore you get to the same result. So unfortunately, if you're doing this cross-sectionally, at least I think that's right mathematically, as I think about that off the cuff, that effectively you get the exact same result because you're subtracting the same number from every single sector of the market. Again, happy to discuss that further with you if you like. How does survivorship bias relate to the relative CAPE ratio of sectors with highest mortality rates? Yeah, that's a really good question, because as you think about it, you're like, okay, we have this sector today, here's the names in the sector, but I'm comparing them to 20 or 30 years ago. And so the good news is the survivorship bias is mitigated somewhat, because ultimately those stocks that go to zero are in the index. So they don't get kicked out. I mean, they may go down 99.9% before they get delisted and go into the pink sheets, but ultimately it is within there. That is in the price of those overall sectors. So when you're comparing these relative ratios, you do get that. So a good question, one we thought about as well, and we just don't really see they're having a significant impact. A related question that's similar but different is how do you calculate a 20-year CAPE ratio on the communication services sector, given that's only been around for 5 years? So the one thing that happened within the communication sector when it got redefined, it's not just the names getting redefined, but they also redefined the sub-sectors within the GICS classification scheme. So you can actually go back and rebuild what, using the new classification schema, forget the names, right? Look at the actual sub-industries that got reclassified to create this. And if you do that, you can create the sector back through time and be able to do that. So yeah, definitely something we thought about that we worked with Barclays on when they were running through all the data on this. Very same question we had, trying to make sure we understand that. So that's a good question. Next is, how are dividends treated in the various indices? Dividends are reinvested and plowed back into the index. So we don't distribute dividends. They get rolled back into the swap. The swaps give you a total return. So whenever you get the swap, what you'll see is that you get the index return, both price as well as dividends. And that goes for all of these things, except obviously the multi-asset trend. When you trade futures, that there is no dividend component in there. It's baked into the price of the futures market. So hopefully that helps you with your question there. Great question. I guess, Jeff, they're on your tax thing, because it says, do any of these funds generate a K1? And the answer is no. These are all 1099 products. They are not K1 vehicles. So they're mutual funds that generate 1099s. So you don't have to go through the cumbersome process of inputting that additional information from a K1. I know that's always the part of the tax return I hate the most. Unfortunately, I have too many K1s. So with that's all the questions we have there. Again, if you have more questions or do you think of something as you flip to the slides again, feel free to reach out to us, fundinfo@doubleline.com. I'll be back in 2 weeks as well to talk about the new ETF complex. We'll talk about our 2 ETF offerings. I'll be joined by Mr. Gunlock as well. So this April is the month of Jeffs and Jeffries doing webcasts at DoubleLine. So I'll talk at you guys again in 2 weeks with my colleague, Mr. Gunlock, and we look forward to telling you more about our ETF complex at that point in time. Take care, everyone. Good luck out there, and make sure you pay your fair share by next Monday. Take care. Bye-bye now.